What's going on, everybody? Welcome back to another episode of Freedom Investor Radio. I'm your host, John Pearl, and today I am joined by Tom Dunkel, who is the Chief Investment Officer at Belrose Storage Group. Tom, how are you doing today?
Hey, John, I'm doing great. I know this will be recorded. This won't come out till later, but today is Masters Thursday and I'm a golfer. So to me, this should be like a national holiday, but great to be with you and listeners today.
Excellent. I didn't know that. I'm attempting to become a golfer. I played a couple times when I was a kid, probably like less than 10 times. And then I just got some clubs last year. So I'm trying to break into the space. It's a lot of fun.
Gotcha.
I'm realizing as I get a little older, it's probably something I should learn how to do and have a be respectable at. So, but yeah, man, let's get right into it. So you're a self-storage guy. That's what we're going to talk about mostly today. What I like to start with is let's go back to your earlier days, to your upbringing. What was it like growing up? Were you in a household with entrepreneurs, or were you more like me, where my parents were both the W-2 route, being taught, go to school, get good grades, even though that's not something that happened for me specifically. But that was the path that I was always set to take and expected to take, where you go get a job, invest into a 401k, traditional investments, and just work for somebody else until you're well on into the golden years. And then you can retire. You're going to expect to make a little less money, take a pay cut, live a simple life. What was that like for you?
Yeah, I'm in that same school where my parents were W-2 folks, and the financial advice that my dad gave me was invest in blue chip stocks and go to school, work hard, all that stuff they read about, rich dad, poor dad. I kind of had the poor dad, and I say that reluctantly because my parents did provide a great life for me and my brother and sister, but they were definitely in the grind and they knew there were entrepreneurial opportunities out there. In fact, I guess it may skip a generation because my grandparents were more the entrepreneurs, not so much my parents. But yeah, that was the upbringing I had. And further to that, and to this day, like my sister, my brother, they're still grinding in W-2 world, and I'm trying to yank them over into what I'm doing, and they're doing it because of course they trust me and everything, but I don't know that they're really buying into the whole self-storage alternative investments, leaving the stocks, bonds, and mutual funds behind.
Got it. So I know, as discussed before we hit record, got a few listeners who are probably attended the same university as you, University of Delaware. So shout out to the Blue Hens out there. And
fighting Blue Hens, John. Don't forget the
that's right.
My
Blue
fault.
Hens. My fault. So let's see. So you went to college. What did you study in college, and what was the plan once you got out?
Yeah, that's funny. I was a musician as a kid, so I was like, hey, maybe I'll go and study music. And my parents were kind of like, that's not really going to work. You're not going to make any money. And then I was like, well, we're at the beginning of the medical technologies and all this cool stuff. I was like, maybe I'll do medical technologies. And they're like, well, you don't really want to spend all your time in a lab, do you? I said, probably not. And they said, well, tell you what, the most versatile major you could get is business. So why don't you get a business degree? And I was pretty good at math and understood the basic business principles, and that there were a lot of different avenues to go. So I did go to the University of Delaware and I studied finance, minor in economics, and I'm glad I did, because that really did set me on a path to understanding business, understanding finance. And then I actually went on from there to the College of William and Mary after working for a couple of years after Delaware. And I did get my MBA, where I focused more on finance and actually tax and accounting. So a little dangerous in that regard when it comes to accounting and such. That all gave me some great training, then go out in the corporate world and do some financial management stuff, which is still serving me well today.
Got it. Now, this is always my favorite topic of conversation. It leads us to where I'm at right now in the corporate W-2 space. And don't get me wrong, I love my job, love the people I work with, but it's just the things that come with working in a corporate environment where there's a ceiling. Sure. You can only get so much of a raise no matter how hard you work and how well you perform. And that's always irked me. So what was it for you once you got into the corporate space that ultimately led you to want to take this leap of faith and jump out into an alternate world?
Well, that's easy, John. I got fired. That's how I ended up out on the street. But just to backfill that story a little bit. So I got out of business school And I went into mergers and acquisitions and corporate finance in the aerospace industry, which was a ton of fun. I worked with some amazing people, some retired fighter pilots and Air Force colonels and Marines. And actually, I worked with some retired astronauts as well. So just was in this amazing environment, and that company was growing aggressively through acquisition. So I was the spreadsheet nerd, right? So I was doing all kinds of modeling and projections and analyzing the markets and doing all that finance 101 stuff, like the discounted cash flows and all those kinds of things. And the CEO was a Harvard undergrad, Harvard MBA, investment banking background. So I learned a lot from him as well as just the rest of the team. So that was awesome. But I don't know if you've done this, John, but when you go to your company's 401k website, and it always has this calculator, right? So you can project out, okay, if I put this much in and I work here for 150 years, I might have the opportunity to scrape together some kind of retirement. So I remember back then, and I was doing pretty good. I was working hard and I was arguing with my boss all the time about how much I was worth and trying to get that raise or that bonus or whatever. But I was doing that calculator and I was like, man, this is going to be brutal. And I'm in the corporate environment, like you touched on, and I'm having to try to climb the ladder and compete with other people and try to get noticed. And I was just like, man, I just don't know where this is headed. But anyway, fast forward, I left that company, went to investment banking, did a couple other corporate side jobs, were growing through acquisition. But I did ultimately get fired in 2006. By that point, I had elevated to the point of being a vice president at a publicly traded company. So when I got the boot, I did have a pretty soft landing because I got like stock options that vested and that sort of thing. So I had this pile of cash. I was ready to take on the world. But like I said, it was 2006 and I am a real estate guy. So I'll just leave that little cliffhanger there for a second.
Got it. Yeah. So yeah, I can definitely relate with the 401k. I've spent lots of time evaluating the numbers and what age I would have to be and such. And I work with a lot of folks who are at that age where they are getting ready to leave the workforce and retire. And something that's it's always bothered me, I guess not always, once I became what I'll say enlightened, I started reading a lot about financial education and investing and really just learning more outside of the traditional school of thought. And just the whole concept of working so many years and retiring and then making less money and having to simplify, that always has bothered me about the 401k spaces and why I have developed such an interest in real estate, because you can reverse that process and continue to grow wealth while you're into your later years. But let's transition over. Tell us about the origin story of Belrose and how you really got into the real estate space.
Sure. So having that realization that you just touched on, John, about where is this heading, right? This corporate life. When I did get the boot and I had the pile of cash, I was like, okay, because I had been planning, I'd been wanting to do something on my own. I just didn't count on that abrupt transition. Although looking back, I probably needed that because I probably would have drug my feet and hemmed and hawed about starting my entrepreneurial journey, which started 17 years ago this month. So I'm very excited about that. So I get out, I want to do something real estate. It's 2006. I figured I had this great background in corporate finance with these great companies. I was with some bad companies too, but you learn from those as well. Great education, all this stuff. I was like, hey, I'm going to knock this out of the park. This is going to be no problem, right? Well, then the Great Recession comes. And that they talk about burning the boats, right? I had burned the boats, right? I had abandoned corporate life altogether and was just gung-ho entrepreneurship. And so they call that kind of thing burning the boats, right? Well, I not only burned the boats, but over those next few years, that nice pile of cash that I had saved up, that all burned up as well, because I was learning really hard lessons as an entrepreneur during that time period, and the things that I hadn't been exposed to or learned previously. But I was determined. And so 2010, I had come across my business partner, Joe Downs. We've been business partners ever since, 13 years. He was in commercial real estate. He got squashed. I was in residential real estate. I got squashed. We ended up meeting at a real estate networking event. And it turned out we lived around the corner from each other. So we just kept in touch. And I said, hey, I'm looking at these distressed mortgage pools. And he thought that was crazy. I said, well, you're a smart guy. Go check it out and let's come back. We'll meet at the bar, at the corner bar in a couple of weeks. And let me know what you find out. Well, he comes back and he says, hey, I think you might be onto something. So that was the beginning of a company called US Mortgage Resolution, which is still thriving today. We've generated over 50 million of revenue in that business over that time period. And so that's allowed us to do some other things in real estate, because distressed debt is great, but it's super volatile, right? It's very up and down, hard to build a business plan, all that good MBA stuff. So we looked at hard money lending. We looked at doing some residential fix and flip stuff. We were partners in a title company for a little bit, but none of those things were really working out. And then about 2017, we started hearing more and more about self-storage. 2018, we started going to conferences, getting educated. 2019, we actually joined a national self-storage mastermind group. And in that mastermind training, we realized, hey, we've got some big gaps in our skill set and our team, because I'm a finance nerd, right? Joe's kind of a finance and sort of sales guy. So we could maybe do the due diligence and underwriting and get the financing for a deal, but we couldn't really generate the lead to get the off-market deal, and certainly couldn't operate a self-storage facility. So through our mastermind process, we were able to plug in those gaps. And so when we had the team together, then we were like, okay, now it's time to rock and roll. So we acquired our first facility in August of 2020, and we just closed on our 12th, and we'll probably close another, I would say, 8 to 10 this year. So we're rocking and rolling pretty good.
That's great. So one thing I'd like to highlight that stuck out to me, something I talk to people about a lot, is networking piece of it. And so you met your partner who you've been working with for 13 years now at a local networking event. And I always highlight the importance of those things.
That's
and
right.
then you learned about a lot of the deficiencies that you guys had by going to larger, more niched networking events, conferences. So I just always encourage people to get out to those. Nothing but good things happen. Okay, but yeah, let's fast forward now. Tell us a little bit about, so a lot of what we talk about here is multifamily. If you ever did go into that space, or did you bypass it altogether? And tell us a little bit about what makes a self-storage investment different than multifamily. I know there's a lot of similarities, but the more I learn about it, it just seems like multifamily, but better and simpler.
Yeah, it's true. Yeah, actually, I've been a multi-family investor as a passive guy since 2013. So I do know that asset class pretty well. And how I came about being a passive investor was I tried to go and find deals myself, but similar to the challenge that we found ourselves in with self-storage, I didn't have the network built and I didn't have the team built to go and find those off-market deals in multifamily. But by the time I learned all of that and everything, we had already transitioned to self-storage. And the reason is really a few key differences between self-storage and multifamily. Probably the biggest one is operating expense ratio, not to throw out too much of a finance term there, but basically self-storage facilities are just way more profitable than multifamily. So let's say $100 of rent comes in to a multifamily property, right? And then you've got to pay your taxes, your insurance, your utilities, your maintenance, your payroll, et cetera, Well, you're out of that $100 at a multifamily property, you're probably going to have about $30-35 left over, which then that's called net operating income. And then that goes to pay the debt. And then hopefully there's something left over for the investors after that. Self-storage is the reverse. So $100 of rent comes in our self-storage facility. Our operating expense ratio is about 30-35%. So that's going to leave $65 of net operating income to pay our debt. And we're certainly going to have money left over to pay a nice dividend to our investors. So that's the biggest thing. Another thing I'd point out is more operational, right? So self-storage facilities are way simpler to operate, right? At a multifamily property, you got people coming in and out all the time, all days of the day and night, et cetera. Self-storage facility, a lot of times someone will store stuff and you might not see them again for weeks, months, years. They might not come back for a while. And so just the efficiencies there are just really strong in the favor of storage. And not only that, and if you have delinquency, right? So multifamily. I'm a recovering residential landlord myself. So in addition, single family rentals as opposed to multifamily. But either way, you're going to have challenges with eviction court, right? I'm outside Philadelphia. You go into Philadelphia as a landlord and try to evict somebody. It's a very, very tenant-friendly environment, i.e. they hate landlords. So I can tell you, we'd have to do a whole other episode about my stories of trying to evict people in Philadelphia. Anyway, on the self-storage side, we're out of landlord-tenant court, right? We are in lien law. And so lien law says day 61 of delinquency, you can send the tenant a notice, and then a short period of time later, it varies a little bit from state to state, but short period of time later, the stuff goes up for auction. And these days, of course, it's all online, right? So just the manager takes a few pictures of the stuff in the delinquent locker, throws it up on a website, bidding. Someone wins. They have 72 hours to come clean out the unit, and they pay us whatever the money is.
So you get the money for that?
We get the money for that. Yep. And then they clean out the unit, right? So then all we have to do is sweep it, sweep, and it's back up for rent, which is another big difference as for storage as compared to multifamily, right? Multifamily, somebody moves out, they probably tore up the carpet needs to be replaced, or maybe you want to put down tile. You want to change out the Formica for granite. You want to throw in a new lighting package. You want to do something with the window treatments, all that kind of stuff. Just even basic stuff, right? Painting, carpeting, especially these days, that kind of contractor help is hard to find and unreliable. And, what seems like an easy project to knock out in a couple of days or maybe a week, next thing you know, it's a month or 2 months. So that clock is ticking and that revenue is just evaporated, right? As compared to a storage unit, which again, it's self-storage, right? It's a metal box with a concrete floor and a roll-up door. And this is not glamorous stuff that we're talking about here. So it's pretty easy to just empty out the stuff that might have been left by a tenant, sweep out the unit, and it can be up for rent later that day. So few key differences that we just touched on there.
And what is it as far as a market and the specific types of properties? What are some things you're looking for in those areas when you're evaluating? I don't know if you're specifically just doing it in Philadelphia, or do you venture out into other markets as well? But what are things you look for?
Sure. This is where, John, the similarities come through between multifamily and self-storage, because just like in multifamily, we're looking for markets that have strong population. Maybe doesn't have to be growing super fast, but it has to be solid and maybe growing at least a little bit. We're looking for jobs creation. We're looking for low unemployment, low poverty, low crime, right? We're looking for infrastructure investments being made by local authorities, expanding highways, putting off ramps, or improving the sewage utilities, all that kind of stuff. Because that means that money's coming into that market and people are coming into that market. And so what that means is that's creating demand for multifamily, and it's creating demand for self-storage. So those are some of the key things that we look at that are very similar to multifamily.
Got it. And what about the specific type of property? I know there's various levels. I don't know if it's considered the same like Class A through Class D in self-storage space. But what about some specific characteristics of a property? Like you see a property and, I got to have that one, versus if you go by and you see it and you want nothing to do with it.
Sure. Yeah, it is the same. That's another similarity between multifamily and self-storage is we do have Class A, right? Those are the fancy ones. They're more the big boys, right? Public Storage, Extra Space, CubeSmart. They have those big glassy 3, 4, 5-story buildings, elevators, everything's bright and shiny, all the way down to Class D facilities, which might be like first generation, built in the 70s, rusty chain link fence and all that. Yeah. So we're kind of in the middle there is where we play. We're, I guess, what you call a middle market player. We're trying to stay below the big guys, but above the onesie twosie moms and pops. Now, that all being said, that's who we buy from. We buy facilities for moms and pops who they're not running it like a business. They're not leveraging technology. They're not pushing rates. The last thing they want to do is have to fill a vacant unit. So what they do is they keep their rental rates artificially low, and that keeps their occupancy artificially high, but that keeps them from having to really engage and manage the business. So what we do is we come in and we do have professional managers. We do leverage technology. Our tenants can rent a unit right from their smartphone. We're rank high on Google, all that stuff. And so that way we're able to create those efficiencies, push the rents, push the market, and all those kinds of things to increase the net operating income as compared to what the mom and the pop were doing.
Got it. And so I know you guys you're not purchasing these assets yourselves. I know you're syndicating them, meaning you're bringing a group of people together, pooling money and purchasing it, and then your team manages the deal. So when you're bringing potential investors in or educating them, what are some of the conversations looking like that you're having? We were talking a little bit before this, how many people consider real estate as an alternative investment, where so many people, especially that I talk to, they're so used to investing in the stock market that something like this feels really risky. So what do some of those conversations look like to you?
Sure, yeah, it is a hurdle, right? So for folks who are W-2 and they've just been pumping money in their 401k and maybe they have a little extra and they put it with their brother-in-law, financial advisor, whatever, I get all that. That's where a lot of people are. And one of the things we're trying to do here at Belrose Storage Group is to help those folks break that inertia. Those things that at rest tend to stay at rest. So we like to have that discussion, get them comfortable with the idea. And you touched on the term alternative investments, which gets me up on my soapbox, right? Because if you ask me, stocks, bonds, and mutual funds, those are all derivative investments, if you ask me. So those are the alternative investments in my mind. If you look at real estate, housing, storing stuff, lending, and all those things go back to biblical times, right? So those are the original investments. Everything that's come since then, if you ask me, those are the alternative investments. Anyway, I'll get off my soapbox. But we have over the years helped folks make that transition. And we actually were able to boil all of our advice down into an ebook, which is available on our website, belrosestorategroup.com. And we call it Safe Investing. And SAFE is an acronym. Investing is not safe. So I have to put that caveat out there, that disclaimer. But SAFE is an acronym. S stands for sponsor. So sponsor is who's running the deal. So at Belrose Storage Group, it's me and my business partners. We have an experienced sponsorship group, right? So you want to make sure you're asking a lot of questions about that sponsorship group. And we have a list of questions. It's not exhaustive, but it gets your mind thinking in the right direction about who you want to work with and who you don't want to work with. A is for asset. What is the asset that you're investing in? Like, I'd love for somebody who's in the crypto world to tell me, what is that underlying asset that you're really investing in? I'm sure there's smart people out there that are doing really well with that. I don't personally get it, but if there's a piece of land, I understand that. And if there's a business sitting on top of it, which is metal boxes with roll-up doors and people store their stuff there, okay, that's something I can get my head around pretty easily. So that's a pretty easy asset to understand. F is for financials. So what are the financial projections? What are the returns looking like? What are the tax implications? So those kinds of questions is important for people to ask. And then E is finally for exit. How do I get out of this thing? You can't go to schwab.com and click sell your position in a Belrose Storage Group deal. It just doesn't work that way. So as an investor in one of our deals, you need to be comfortable that your money is going to be tied up for a year and a half, 2 years, 3 years, maybe longer if it's a development deal. So the point of the book, John, is to just give people some comfort, a due diligence framework, because a lot of people, they don't know what questions to ask. So they just don't ask any and they stay where they're at. So we're hoping with these questions, they can start getting comfortable and move into these great investments.
That's excellent. Yeah, the due diligence piece of it, that's super important, because I think we're going to see here in the near future, for the past decade or so, everybody's been doing well. And now it's more important than ever to really learn how to do the due diligence on the deal, on the sponsor, and actually do the due diligence, not just learn how to do it. But I think a lot of people learn it and then they're just like, oh, that's a good deal. What could go wrong? But I can assure you, based on personal experience, that things do go wrong and they will.
Yes.
And so with
Oh
that
yeah.
being said, though, with the current financial or the banks collapsing, the financial crisis we're potentially seeing, what is that looking like in the self-storage space?
Yeah, it's a great question. There is a lot of things going on right now, right? The lending environment has been challenging. We've got this inflation going on. There's lots of uncertainty out there, but this is the kind of environment that I feel is built for real estate investments. And of course, we love self-storage, so I'm a little biased in that regard, but self-storage as an example, and I'm sure other real estate asset classes might have similar stats, but for 40 years, storage facilities around the country have maintained an occupancy rate gently meandering between 80 and 90%. So what does that mean? Well, if it's 80 or 90% occupied, and if you think over the last 40 years, we've had ups, we've had downs, we've had big ups, we've had big downs, everything in between, but it still stays right there, 80, 90%. That means that storage facilities generate consistent income, right? And it's built on dirt, and dirt is not going to zero, right? I remember back in the internet days, I had some stocks. I was like, yeah, they can't possibly go down any farther. Next thing you know, they're like down to zero, literally. That doesn't happen in real estate. So for people today, I think it's really important that they look at capital preservation and think about growth for maybe a couple few years from now. But what we love about storage is it provides capital preservation because it's a hard asset. It generates income because it, like we just talked about, it's consistently occupied. And there's certainly growth potential for when a professional company like ours comes in, we acquire a mom and pop facility that isn't being run properly, we can create that growth. So those are the three key things that investors are looking for: preservation of capital, income, and growth. And so self-storage provides all three of those. And if you want to throw in a fourth, we've got tax benefits as well.
Got it. Yeah. And I always tell folks, like, an environment like we're seeing right now is, don't get me wrong, take action, but I love the syndication space for environments like this. Again, going back to the due diligence piece of it, you perform the due diligence, you build a relationship with a quality operator. And why wouldn't you want to invest with somebody who's been doing this like yourself for over a decade versus going at it alone and going at it for your first time in an environment like we're seeing and trying to navigate those rough waters. So that's one of the main reasons I love syndication. But what do you see right now that may be similar to the lead up to 2008, or maybe that's not the same? A lot of people compare it, like, is this GFC part two, global financial crisis, that is? And what, in your opinion, are you seeing the similarities or the differences?
I think there's more differences than similarities, in my opinion. Having lived through the Great Recession before, when I burned through all my cash, that was a different time. The lending market in particular was way more cavalier, right? They used to say anyone who could fog a mirror could get a mortgage, right? So I remember back then, part of what my company did and failed at was short sales, right? So we would go and we'd meet with these people where they owed like $500,000 on a $200,000 house, and they made like 30 grand a year. Like, what? How did we get here? We're in a completely different environment from that now, because lending standards, credit standards have been increased substantially. And there's a lot of cash still on the sidelines, right? So there's a lot of liquidity in the market now. Back then, not so much. People had been buying and buying and buying stocks and houses and houses. And there's the movie The Big Short. These group of ladies in that movie, they own like multiple condos. Anyway, a great movie if you haven't seen it, The Big Short. So the book is better, of course, but so, there's more differences like that than similarities. I think the similarities are There is uncertainty, right? A lot of people are thinking that we're in this bubble that was bigger than 2008 on the residential real estate side. So there's a maybe potentially even a bigger correction going there. But who knows? There's arguments on both sides. But I keep going back to what we talked about a minute ago with storage, where it's been steady through all those ups and downs and big ups and big downs and everywhere in between. So that's what we really like about it is if things aren't going to be as bad, then, we'll be okay. If things get better, we'll be okay. Because I think that's the key that I haven't quite articulated yet, is that people need storage in all different environments, right? When things are bad, they're having to sell their house, they're having to combine households, they're having to relocate or move or what have you. That's when people need storage, right? Divorces, downsizing, all those kinds of things. When things are good, people are buying stuff, they're buying the kayaks, they're buying the motorcycles, they're buying the mountain bikes, and they need some place to store it. So good times, bad times, people have stuff that needs to go somewhere.
Yeah, and you touched on it a little bit, that there's so much liquidity sitting on the sidelines. That's one of the things that really just makes me think that we're not going to see a big downturn, at least in the real estate space, because as soon as things start going down, they have a little bit, but people are just going to start buying it back up. I think a lot of people don't realize that since 2020, 40% of the money that is in the current supply was created. So between now and 3 years ago, 40% of the existing money was created. That just boggles my mind. That's really when I got super interested in learning about how all this stuff works and how it impacts the current money supply. And it's just mind-boggling. So I don't really see a huge downturn. But
along those lines, John, here at Belrose Storage Group, what's going on is it's not like it came out of nowhere, right? So we've been tracking this for years now, right? So we've built up a lot of cash. So we're waiting for that correction. We're waiting for things to come down a little bit because we think they will. And so we're ready. And by the way, if I haven't mentioned this before, we invest alongside our investors in every deal. So we have that skin in the game. So we have cash ready to deploy. And the other thing we're seeing a lot more of right now is seller financing. So what is seller financing? If I could just spend a second on that. So let's say there's been a storage guy, right? He's owned this facility for 20 years. He hasn't really run it that well, but even the run up in pricing and whatever, all of a sudden he's got a ton of equity built up in this self-storage facility. Along comes Belrose Storage Group, say, hey, we want to buy your facility, but our lenders over here, they're very volatile. Rates are way up now. We're starting to see rates like in the 9s, etc. We say, hey, Mr. and Mrs. Seller, you've got a lot of equity in your property. How about we give you enough cash up front to pay off what's left of your little loan, maybe give you a little pocket money, a little walking around money, and then you can hold a note, right? You can seller finance, you can be the bank for that remaining balance. And there's a couple advantages to that. Number one, you're still going to get some cash flow on a monthly basis as a seller, right? If you sell the business, the cash flow goes away. Well, in this situation, it allows the cash flow to continue. It might be a different amount of cash flow, but it's still coming in nonetheless, because a lot of these folks, when they sell, they're looking to maybe retire or do something different. So they want that income. And the other thing is, and I'm no tax accountant, but they get to defer the payment of their capital gains from selling their facility that they've owned all this time and have all this equity. And that gain is taxable if they were to sell it all right now. But if they sell or finance it, they can drip out that gain over time and it reduces the tax bite. And then for us too, we're usually able to get better terms from a seller than from a bank. So what I mean by that is a lot of times we're able to negotiate interest only payments. So instead of paying principal and interest, which is a bigger payment, takes up more of our cash flow, we're able to just pay interest, which makes the cash flow increase comparatively, which means we have more money to pay our investors. So there's a lot of win-wins there. And we're seeing more and more seller financing now that rates are up and banks are scared.
Yeah, that's great. Seller financing that's like the ultimate goal for me when I first started doing this, was like, I got to find somebody who I can who will do some seller financing. That's awesome that
Mhm.
you guys are able to do that. Tom, I want to talk a little bit about like the mindset piece around what you've managed to accomplish over the course of your journey. You've mentioned a couple of failures over things maybe that didn't go as well as you had thought, and you've been doing this for a long time now. So what do you tell people who are just getting started and experiencing some road bumps and they're thinking of maybe throwing in the towel? I know it's not been easy for me. I've been doing this for about 4 years now, and there's definitely been some tough times. So what are your thoughts on that?
Yeah, it's a great question, John. It's not for the faint of heart to go out and be the entrepreneur, the operator. I think being a passive investor, that's an easier way to go about it if you get with a good sponsor and a good syndicator. But as far as being the operator and doing the grind every day, it is challenging. I guess what keeps me going at the end of the day is the hours I put in and the grinding that I do is really it's for me and my partners and my family and our families, right? It's for our business. I know when I was way back in my corporate days, I'd be working late and working hard and I'm doing this work for other people. Sure, I benefited up from it, but they benefited way more. Whereas now it's, hey, this is for me, this is for my family, this is for our future. That when I was in corporate life and I couldn't see like where this was taking me and the calculator and all, now I can see it, right? That the results are up to me. And sure, that can be a burden from time to time. It can be a heavy lift. Frankly, right now we're going through a growth spurt in our company, which is really hard. We're needing to raise a ton of capital right now. We need to get a bunch of lender relationships going. We've got operational challenges we're working through at a couple facilities. And so, yeah, we're really grinding, but I think it's good to be surrounded by the right people. So you're arm in arm going through the battles together. I think that's super important. My partner, Joe, like I said, we've been partners 13 years. And I think a big part of that is because we do have those similar values. We're doing this for ourselves and our families. Our partner, Tim, he's newer since we got into storage, but he's of the same mindset, right? And so I think we feed off of each other. And when one of us is down, the other guys lift us up and vice versa. So I think people, vision, all that good stuff is really what you need to just get through those tough times.
Oh, that's great stuff. I couldn't have said
Because
it
they're
better
coming.
myself. Yeah,
100% chance.
100%.
100% chance you're going to go through some tough times. 100%, but it's worth it.
Definitely. All right, Tom, time for one more question. It's a question I ask all of my guests. Touched on it briefly before the show, but I work at Diablo Canyon Nuclear Power Plant that recently announced they're going to be shutting down in the future. And my goal is to replace my income from W-2 space with income from real estate investing. So what's your one piece of advice you would offer to somebody who's looking to do something similar, whether that's escape the W-2 space and start a business, entrepreneur, become a full-time real estate investor? What would you say?
Sure, I would say if you can avoid it, don't do what I did. Don't don't get fired and then find yourself on the outside. I would say come up with a plan. And then it's going to take work, kind of like we were just talking about. So I think evenings and weekends, I would say, well, in these days, right, with a lot of virtual work being done and whatnot, maybe you can make time during the day. But I would say just start networking with people. Go to the real estate investor networking events. Try to connect with people who are doing cool stuff that you think is interesting and do your due diligence, ask the questions. And what I found too, John, is some of the which I think is a smart strategy that I never did. But now that I am in like a mastermind group and I am actually involved in a few of those, there are people who pay money to join these groups to find the top syndicators and the top thought leaders in those areas. And then they invest with them. So it's a little investment of time and money up front, but you're learning and you're finding those syndicators and those thought leaders in that asset class or whatever that you think is interesting or has a future. And I was like, wow, that's really smart. It's some money up front. So there's that investment. But if you look at it over the longer term, I think that's a great way to get educated and make sure you're putting your money with a trusted partner.
That's excellent. Love that advice. All right, Tom, where can people reach out to get in touch if they want to learn more and connect?
Sure. Thanks, John. This has been great. I'm Tom Dunkel, Chief Investment Officer here at Belrose Storage Group, and you can find us at belrosestoragegroup.com, where I invite folks to download our safe investing checklists. You can get those due diligence questions in front of you and start that step forward toward investing in real estate. And we also have our investor portal on there for folks who might be interested in investing alongside us in a self-storage deal. We have an investor portal that you can sign up in. And when our offerings come up to invest in self-storage alongside us, you can find all the information there. And on Facebook, you can find us as well, Belrose Storage Group Facebook page, where you can see me and my other podcast interviews. And we try to put some other value add information out there, articles that we think are interesting for investors and other industry participants.
Excellent. All right, Tom, thanks again for your time. Had a blast chatting with you. Ladies and gentlemen,
Great.
Tom Dunkel, Belrose Storage Group. Thanks so much.
Thanks, John. Thanks, everybody.